Hello fellow traders, Marv Eisen here from Timeless Dollar Trading Academy. And trading is like predicting the future. If you're good at predicting the future, you're going to be great at trading. But there's a little bit of a problem. Nobody can predict the future, all right? So there's a problem with predicting the future. So how do we trade successfully? Well, to trade successfully, you have to go back to some of the certainties of the market. Now, what are those certainties? Well, I'm going to refer you back to the one-day chart of the S&P. And here's the one-day price chart of the S&P. And what do you see? A bunch of red and green candles. And these candles are the daily price movements that prices range from top to bottom, from high to low, throughout the day. And what is common about these candles? Yes, some are red, some are green. But what's common is that they have a beginning and they have an end. Now, the key is, where is the beginning? Is it at the top or is it at the bottom? That is the trick. But nevertheless, this is a basic. Candles are a basic of trading. Sure, that makes sense, right? But how do we know which is the top and which is the bottom? Because the only thing that is going to be the most important thing to learn in trading is, where is the market going to go today? If we're day trading, so we're only concerned about one day. So we want to know what the candle is going to do. Is it, when it opens, is that the top? Is it going to go down? Or when it opens, is that the bottom? And is it going to go up? Well, for that, I use some numbers based on George Taylor's work back in the 1950s. And here on Wednesday 18th, this was the daily trading range that I calculated using George Taylor's numbers, the Taylor Trading Calculator. And these numbers were developed by Mr. Taylor 75 years ago, and they're still valid today. And they're used all over the world by traders in virtually every market. I only trade one market because I want to be familiar with the market that I'm trading, and I sort of have an idea after 20 years of what the market is going to do. Not all markets trade the same. In fact, most markets have a personality of their own, all right? A little bit like people. Here is my range for Wednesday, December 18th, which happens to be an FOMC announcement day. FOMC is Federal Open Market Committee meeting, where 8 times a year the Federal Reserve sits down, the governors sit down, and they decide where to set interest rates. And interest rates are a key to what the equity markets are going to do. Okay? So on Wednesday, December 18th, support was down here at 61.20 and resistance at 61.50, about a 30-point range according to Taylor's calculations. And so I start my day drawing this rectangle out on my chart every day, okay? And I also put the previous day's close. I put a horizontal line, which was down here at about 61.28. And so these are price targets that the market is likely to trade at. So where did the market go on Wednesday, December 18th? Now, as I said, we want to know if the market opens at a particular point. From that point, is it going to go up or is it going to go down? That's the most important thing, because whether it goes up or down, I figure it's going to move in a 30-point range for the day. Doesn't always happen, but according to the Taylor numbers, it happens an awful lot. This is the most reliable method of trading that I've found. Of course, there are trading setups, and there's a lot of psychology to trading. I'm going to get into that in a minute. One of the things I tell traders who are just starting out on FOMC days, don't trade around the time that the announcement is made. And it's always made on a Wednesday at 2 p.m. So I tell my newbie traders, or even novice traders who should know better, don't trade just before or after the market announcement is made, the FOMC announcement is made, because the market tends to whipsaw then, moves very quickly, okay? And so I'm going to show you what the market did on Wednesday, December 18th, and how I played it, and how you can play it as well, okay? So I'm going to play this video of how prices moved. I'm going to slow it down a little bit. This is a little too fast. prices came in, and this is just about at 9:30 when the market opened, all right? The market opened, and where did it start out? Well, it started out just about at the bottom end of the Taylor trading range. Okay, so that tells me, well, am I going to look for the prices to go up from here or down from here? That's what I'm looking for. And so I have to make a determination now, and I have to learn to see what the market is going to tell me. You can't learn this from talking heads. You can't learn this from the Wall Street Journal. You have to learn how to read the market. And for that, you have to look for the intraday high or low in the first half hour to hour of the day, and then you have to see where it breaks. And that'll tell you whether the direction is going to be up, most likely, or down, most likely. All right, so let's continue. So the market opened, and it's just about right over here. It's trading at about 10 o'clock. I have my cursor right here at 10 o'clock. Okay, I'm going to stop it. Now notice that it put in a low right over here at 61.19, and it broke the high right over here at just about a little before 10 a.m. It broke this previous high, okay? Here was the previous high, which happened to be just at the beginning of the day, just after the market opened. And right over here, prices broke that high and continued up. So it's a pretty good guess the market is going to go up. So this is the point, this is the place to get in. Now, where is the market going to go? Well, the market has a range, and that's what I use Taylor for to tell me what the range is. And I already told you the range on this particular day was 30 points. So let's see where the market went. Interesting, right? Interesting, right? Okay, so the market came within 2 points of the calculated resistance at 61.50. Came within 2 points of that. And so starts to back off. Let's not be greedy. We got on at around 61.30 up to 61.50, 20 points. Okay, in about, how long is this? From 10:18 to 10:50. And that's it. Don't stay beyond the success. If you have a successful day, whether it's 20 points, 10 points, 5 points, go home. Forget about it. That's the day. That was the move for the day. We learned where to get on. We learned what to watch for, rather. We learned where to get on, right, when it broke. And we learned to stay on for the range. Okay, that's when we get off. Now, what happened the rest of the day? As I told you, this was an FOMC day. So I'm going to move forward to just before 2 p.m. Okay, it's 1:30, just before the FOMC announcement. And now the FOMC announcement is right in front of us. It's coming, it's coming. Wow, look at that. Look what happened at 2 p.m. at the announcement. Did you see how fast that went? Now, I know you could say, well, Marv, if I stay on, just maybe I'm going to guess right, and the market is going to go my direction. I'll make a lot of money very quickly. But here's the thing. The market moves so fast at the FOMC announcement times that when you put in an order, which is normally closed like that, you can't get out, especially when the market is going to drop, because nobody is going to catch a falling knife. That order is going to sit there until the market decides it's going to bottom out. And so where did the market end up on Friday, December 18th? I'm going to compress my chart. Do you see what I'm showing you? If you stayed on and you were right, great. But if you were wrong, the market went from 61.34 down to 59.50, about 80 points. Went down 80 points in a very short time. And I'll tell you, my friends, you will not be able to get off. You can enter an order. That order is not going to be hit. You're going to stay in that market until the market decides it's going to take you out. And you're going to lose a heck of a lot of money. 80 points, $50 a point. You don't want to be that guy. All right, so that's how you trade. You don't trade around FOMC times, and you trade knowing the Taylor range for the day, the Taylor calculator, and how to determine which way the market is going to go. So there are other ways to trade. There are a lot of people, this is certainly not a scalping method. Many people, particularly newbies, they trade scalp trading, and they're in and out 20 times a day. And typically they lose money. Even if they make money, they lose, because the in and out, the brokerage commissions are going to eat up any profits that you make. So that's my video for today. A little long-winded. Anyway, but thanks so much for watching. Trade safely. Use lots of patience. I'm Marv Eisen, the Time and Style of Trading Academy. If you want to learn how to trade or learn about the tailored trading calculator, go to my site at timelessdollar.com. Take care, have a great weekend, and happy holidays.